Okay, well, look, thank you very much indeed for inviting me again to one of your conferences. So MI2 Partners is a macro research shop, but it's a slightly different research shop in the sense that we set to try and make people money. I'm not interested in talking about economics. I'm not an economist by training, nor any of my team. We are strategists and we are risk takers. And I think there's an awful lot of talking and pontificating about the economics and what it means, but you've got to translate it into making money. And that's what we try and do. And and just fortunately, I guess Marty asked me to talk, I think at a very, very interesting point. And I do, given this West Coast audience, I'm a little sensitive about the topic, but bear with me. And I hope you have some questions at the end. So we have called this presentation exceptionalism. You know, there's a lot of talk of US exceptionalism or reflexivity. And I just want to go through and talk about this. And bear in mind, I am not an equity strategist. I am a macro guy. And so we're talking at things from sort of 40,000 feet. So let's go. So the first chart I want to show you is a chart of the MSCI US. So this is a broad metric of the US equity market. You can see this in orange against the rest of the world equity market, ex the US. And what you can see is that the white line outperformed materially up until 2014. Makes sense, you know, it's a higher beta, more risk overseas than would have been in the US. And then starting in 2011, the US kind of started to play catch up and it materially diverged from the rest of the world in terms of performance starting in 2014. What happened in 2014 that could have caused that? Well, then you can see here, we had a massive divergence of monetary policy. So as the US started to hike and start to shrink the balance sheet, Europe and Japan moved into negative interest rates. And we would postulate that this triggered a massive rally in the dollar and started to suck money into the US on a relative attractiveness basis. This went really parabolic, starting with COVID and then with the AI boom again. The net result, when you look at this divergence of monetary policies, it drove something like dollar yen from 80 to a high of 160 until recently. And it drove the euro from 160 down to 1. And this is all driven, as you can see here, by the relative interest rate differential, in this case, bonds, previously JGBs. Now, this booming equity market also had another effect. It led to a booming economy. The US is in what we refer to as a hyper-financialized economy. In other words, in a very screwy way, ladies and gentlemen, it is not the real economy that dictates what happens to asset prices. It's asset prices to determine what happens to the real economy. Because very simply, that's how CEOs are paid. Up until recently, we didn't even want CEOs to make a profit because we were more interested in them piling back all the money into growth. And you can see here that basically all other things being equal, the US equity market leads total employment in the United States by 6 months. And it's very simple. If stocks are rising, CEOs hire. If stocks are falling, CEOs fire. Now, the equity market can get it wrong. It can get way over its skis, as it did in 2008 and again here in 2022, 2023. But all other things being equal, this suggests that far from falling, the risks are, if anything else, that growth will re-accelerate in employment as we move into 2025. The boom in equities also, and to a lesser extent in real estate, created something unprecedented. An unprecedented boom in wealth for wealthy Americans. We are talking monumental amounts of money that have been created by the rise in financial assets. Since 2011, household wealth has jumped by $100 billion or 350% of current GDP, with half of those gains, half of them coming in the last when stocks went utterly parabolic. What this has done is created an utterly, once again, unprecedented two-speed economy, where the wealthy, and these are confidence data that you can get from the Consumer Confidence Survey, stock holdings, or the confidence of people with stock holdings over $500,000, has never been higher and has utterly diverged from the bottom percentage of the population who have stock holdings under $10,000. We have never, ever seen anything like this. Now, this is all, as you can see, started in 2011 and really started to diverge once again in 2014, 2015 level. Now, the good news is that the wealthy are responsible for all the discretionary spending, right? Vast majority of people, the bottom 80%, we don't really care what they spend their money on from a GDP perspective. You certainly do from an asset allocation perspective in the equity market, but they just spend all their money. The check comes in and it goes out. The only people that matter from a discretionary perspective are the wealthy, and they are feeling very wealthy. And there is nothing more discretionary, and this is just a metric, than your plan to take a foreign holiday as an American. And you can see here that currently is running at about 20% of Americans think they are going to take a foreign trip in the next 6 months. This is absolutely bloody amazing, ladies and gentlemen, because only 48% of Americans have a passport. So a whopping 40% of Americans who have a passport plan to take a foreign trip in the next 6 months. The only problem that you can see, or 3 months, sorry, the only problem that you can see, it is utterly correlated to the outperformance of the equity market. Now, the other problem, and this is the big one, is that we have to pay for this spending, right? Starting in 2020, the US current account deficit has ballooned. It is currently running, and this is a run rate, at $1 trillion a year. And that has to be fully funded by foreigners. We cannot go and buy a German car manufactured in Germany in dollars. We need euros, and we have to get them somewhere. And not only are foreigners funding the $1 trillion a year, but they are also funding about 30% of the budget deficit. Now, so far, how have they lent us this money? Well, in part, they've lent it to US banks, and indeed the total foreign liabilities of the US banks deteriorated quite markedly between 2021 and 2022. But starting in really at the end of 2022, it's gone nowhere. So what have they bought instead? They have bought US assets, and they have bought it in size. So when you look at the breakdown of what they've bought, you can see stock purchases, corporate debt purchases, and treasuries. And what you see is Europe's been a pretty aggressive buyer of stocks, less so Asia. Asia is particularly piled into corporate debt, and we believe that that's Japan. And you can see that in the news, of companies like Norinchukin. And Europe's also been a pretty aggressive buyer of treasuries. Now, what has this created? This has created a virtuous cycle. This is what US exceptionalism is, right? And you can start any way you want on the cycle, but bottom line, let's start where we were in 2014. So get high yields and dollar strength sucks in foreign capital into the US via the capital account. Piles into US assets, US equities start to outperform. Courtesy of hyper-financialization, this drives hiring, and it also drives consumption via that wealth effect that we discussed. As the economy booms and the current account deficit balloons, that has to be funded by more inflows, and the Fed hikes, so the dollar goes up even more. So you create this true virtuous cycle, okay? The problem is this virtuous cycle is arguably not exceptional. It is simply and utterly reflexivity. Reflexivity is a thesis that Soros came up with to discuss and explain to economists who constantly believe that markets are in equilibrium, that markets can get well out of equilibrium. Because what reflexivity discusses is how you create a self-reinforcing feedback loop. In particular, where the purchase of an asset underpins the fundamentals that justify the price of that asset. So the more you buy, the better the fundamentals. Now, in the virtuous phase, this is intoxicating, it's powerful, creates the conditions of this sense of sort of unassailable equilibrium that we're going to go on forever. Yet in the reality, this is simply massively dynamic disequilibrium. It is, Soros described it as far from equilibrium, because the very factors that drove the virtuous cycle, if they start to alter, can create the potential unwind, which can be vicious. And what are those factors in the US's case? A strong dollar, the dominant outperformance of US assets, and that economic outperformance with the associated current account that has to be funded by foreign inflows. So let's go and look at some of those metrics. Let's start with the economy. The first thing, guys, to understand is that a Goldilocks landing is not the base case, ever the base case, right? It is a very, very rare outcome. We've had 12 tightening cycles since the 1960s. Okay, we've had 8 clear recessions, and we've only arguably seen 3 soft landings. Now, if you look at, can someone put those on mute, because there's an awful lot of feedback going on. Sorry, Marty, it's just an awful lot of feedback.
Give me a second here. Yep, got it.
This one here, which you can see, 1966-67, is purported to be a soft landing, but we'll go into why it was not really a soft landing. So of the soft landings, we've had 3 out of 12 tightening cycles, right? So 25%. Furthermore, I don't know if it's on mute. Maybe it's you, Marty, in the room. I'm not sure.
There's somebody in the room. Don't worry about it.
No worries. Okay, so why are these also unlikely? Well, in every single one, if you look here at the unemployment rate, when we started after the end of the tightening cycle and the expansion started, okay, as the Fed started to cut, we had a lot of labor slack to expand into, right? Even in the late 90s, which is the one that everyone holds up, that they believe that's where we're going, we started the easing cycle and we started the expansion with 6% unemployment, and unemployment fell 200 basis points. Do you really think we're going to 2% as we expand in unemployment? Because that's where we're starting from would suggest. The only time that we've tried to have a soft landing from this level of unemployment was back here in 66, 67, which we'll discuss in a second. Now, to help us achieve the soft landing, the Fed adopted a very unusual pattern. Typically in a tightening cycle, they would drive Fed funds at least 100 basis points. This is the bottom of this band here, at least 100 basis points over nominal GDP. That would have taken Fed funds to over 7%. They chose not to do that. They left them about 150 basis points shy of that level. And the only times that we've done that are here in 1966, 67, or here in the late 90s, right? The true Goldilocks, Greenspan-esque outcome. Now, how do we end up with that Greenspan-esque outcome? We get productivity. In the late 90s, you can see here, we got a burst of productivity that takes basically productivity from 0 to about 4% on a continuous rising basis. Nominal GDP runs extremely hot, which is great for the equity market, but it isn't bad in this situation for bonds because inflation falls because you have productivity. But you can see unemployment falls from about 6 down to about 4 and change, where we actually are currently, and average earnings grow, right? Now, that's not inflationary because you get the productivity. Now, here's the problem with that, given the current setup. Firstly, in the late 90s, we did not get hundreds of basis points of rate cuts. We got 75 basis points of rate cuts, and that was it. Then the Fed left rates unchanged for 30 months, right? So for a long, long time. Okay, best part of 2.5 years. Okay, so if you are in we are going to get the fantastic productivity-induced late 90s kind of run with AI doing it. Firstly, know that that's only occurred once in the last 60, since 1960. Okay, but maybe you're right. Okay, but know that you will not get the rate cuts in that scenario as anywhere close to what is currently priced into fixed income. Secondly, thus far, there are really very few signs of that productivity miracle. In the late 90s, you can see that we had a period, and maybe this is the beginning, okay, but an extended period of rising productivity. So far, productivity has been falling broadly for the last 4 years, not rising. And until that productivity shows up, you run two risks. The first risk is that you lose momentum in employment. Now, just so you know, the reason why you can run a moving average over unemployment is because it is a momentum indicator. And just when anyone says to you, yes, but we're going from 3.4% to 4%, right? Employment is still incredibly tight. We have gone into a recession with inflation, with unemployment in the twos. It is never about where you start from. It is about the rate of change with unemployment. Okay? So given where we are now, and we can argue the toss about, is it immigration that's distorting the number or not? The statistical base case using 75 years worth of evidence is that we are going into a recession. Okay? Have to be a very unusual situation. There is one where we tipped above this line, not as much as we did now, right? But we'll come to that, the 66, 67, where we started to move up and we pushed unemployment back down. But that would bring you to the second big risk. Because in 1966, 67, if you look here, we had a period of nirvana in terms of inflation, very low, oscillating around, just above 1%. Unemployment is falling. Everything is great. Then you get a pro-cyclical stimulus in the economy, right? Which I would put very similar vein to the COVID stimulus that we got. It was pro-cyclical, unnecessary, poorly timed. What it does is it pushes inflation out of the range. The Fed hikes 275 basis points. We get an equity market correction, a little bit of a credit crunch, and then they ease. And they ease into ongoing fiscal spending, which we have currently. Unemployment never loses its mojo, tracks sideways for a little bit. Average hourly earnings start to rise again as we push it back below 4%, and your inflation comes right back. So your two risks, ladies and gentlemen, are nothing to do with a soft landing. In fact, if you look at the historical summary of a soft landing, the odds are at best 25% and never from this level of unemployment. The biggest base case is a recession. And your, odds of a reacceleration and a resurgence of inflation is 8. So the odds are 3-1 against a soft landing. And yet that is fully what the market is priced. Now, in fairness...
Julian, can I interrupt 1 second? I know that you're on a roll here, but, this whole thing about 1966, 67, wasn't the stock market flat for 10 or 15 years from that period onwards? Or...
In total, the total gains were pretty small, Marty, but your swings are enormous. You had boom bust. You had periods of extreme boom bust, extreme volatility.
And that might be the best case scenario.
I think that might be we've talked about this, what we call this accelerative oscillation, where you end up basically policy error begets policy error. And we think that's what you may get. You may get a period of extreme, back to sort of away from the great moderation that's persisted since the great 80s. So you go into this series of boom bust cycles where the Fed consistently gets it wrong in terms of its read on the economy, and they overstimulate at the wrong point, but if I show you a chart of the S&P in the 60s, you will see here's the initial drop in 66, 67, 20 odd percent. We then get a bounce as the Fed starts to ease. The bond market yields are just rising the whole time. We don't break a new high until 67. Then we have another sell-off. We make another new high. Then we have a 37% sell-off. Then we rally, and ultimately we end up with a 50% sell-off. So,
and just to give you some more background and some of the other things you talk about, Europeans buying American assets. I spent a lot of time in Florida. I've been told that on Brickell Avenue that had a building boom. All these apartment buildings have gone up, multifamily, and so they said that 90% of the Brickell building since 2009 has been EB5 building, and less than 40% of the apartments are owner occupied. So I think that gets back to your whole speculative.
Yeah, I mean, look, someone
States,
exactly. Someone is funding our profligate spending, right? If you want to call that exceptionalism, fine. I don't call that exceptionalism, right? Now,
yep.
If you look at things at face value, ladies and gentlemen, it is true Goldilocks, right? So we have falling nominal GDP, okay, but it's still extraordinarily high. Just so you know, okay, the concept that we are easing rates with nominal GDP at 6% is quite remarkable, right? Because we haven't achieved sustainable levels of 6% GDP growth apart from, say, 2004, 2005, and 6, right, where the Fed was hiking, or in the late 90s when the Fed was hiking, right? But nonetheless, CPI has fallen further and real growth has accelerated. So that kind of looks like Goldilocks. But here's the thing. Monetary policy works with a lag. And as I said, and this is using a different metric this time, this is using part-time for economic reasons. So think of it like this. This is little Johnny. He works at a factory. His boss comes up to him and says, sorry, Johnny, I know you're working 5 days a week, but we're not making you unemployed. Let me clarify that. We just need you to work 3. That is the final stage before little Johnny gets canned. Okay? And you get all these other things. You don't hire as many, you just don't replace people, right? And then you put people on to short-term or part-time work for economic reasons. And here's what I want to point out. In every recession going back to 1955, we've seen momentum fall in this metric. So you're falling, then you start to lose that downward momentum. And then in 1 month, you get a big spike. Here, 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 here. With one exception, 1990, we were already in the recession at that point, and we got it. We've seen it over the last 2 months here. So using a metric that is 65 years worth of data, the odds are 90% we're already in a recession. Do you want to take the other side of that trade? That's a pretty aggressive trade. Now, don't forget, the bond market is also telling you that something bad is going to happen. If you go back to 1977, the reinversion of the bond market, the bull steepening move in the bond market, when 2-year yields fall faster than 10-year yields, has always been associated with something very bad. The Volcker recession, the Latin American debt crisis, the 90s recession, the Asian crisis, the dot-com bubble, the GFC, COVID, right? We were already slowing in 2019, even before COVID hit. Okay. This is not a scenario that is remotely priced into the equity market, right? Before anyone says, okay, yeah, but, in 2020, stocks went up. In 2020, stocks eventually went up. They initially fell 30%. And by the way, that is typically what happens in a recession. The average decline since 1935 in a recession is 30%. And more recently, actually, arguably even bigger. The other big thing that we mustn't forget is that during COVID, okay, the Fed printed the best part of $6 trillion. We are going into this without the printing press at our back. Okay, so if you think that tech stocks are going to save you like a replacement bond like they did in 2020, please think again. If we go into recession, which is the base case of every single tightening cycle, and currently, given these employment metrics, looks like a risk, okay, a material risk, the average return in the US equity market is 30%. Now, in terms of talking about this broadening out, this is a chart that we sent to clients back here. And we said, we just hit this ratio between the more broadly equally weighted SPW, the S&P broadly weighted, the equally weighted S&P versus the S&P. So think of this as a growth value metric, right? Think of it kind of as tech against value play. And you can see here that, yeah, sure. I mean, I guess you could argue that this is where the levels that we hit in the GFC and in COVID. So you're meant to be just long, and I'm not, arguing against that. You're meant to be long the equally weighted, for this broadening out play. But note that we did it in 2002. We rotated into a recession, into a bubble. Okay. Now, the other thing to remember is there are some clear bubbles in this. And I'm sorry this is coming on the West Coast here, but just so you know, I am not interested in NVIDIA in terms of its earnings. I'm only interested when I look at classic bubbles. And we've looked at classic bubbles going back to 1929, and single stock bubbles and index bubbles, right? Bubbles are not about fundamentals. Bubbles are about ownership. When everyone is long the stock, there is only one way the stock can go, and that is down. Because this period here, the mania, is driven by greed, and this period here, the bust, is driven by fear and positioning. Right? So if I look at NVIDIA, it is a classic bubble. It has all the characteristics of a classic bubble. A classic bubble typically bursts within 12 to 18 months, and you are down at these sorts of levels. $20. Okay? Now, in the scenario that equities decline, if you go back to that reflexive cycle, if equities start to decline, or if the economy drives us into an equity decline, the current account deficit will shrink. You can see it here. By the way, the last time we funded a current account deficit with equities purchases from abroad was during the dot-com bubble. But you can see here, recession, current account deficit shrinks, current account deficit shrinks, current account deficit shrinks. Okay? 2022, current account deficit shrinks, but now it's exploded. In that situation, it is possible, maybe, that the Fed punts the cycle, but they are going to have to slash rates, right? I mean, slash and burn them. Now, as I said, this is just another way to look at it. Typically at this point, even if the Fed cuts, they cut here, they successfully extended it, but we weren't above the moving average. We were tracking sideways. They cut here, but it failed to prevent the turn. They cut here, but they failed to prevent the turn. They cut here and they successfully punted the cycle. The only time where we've been above the moving average and they've successfully punted the cycle was 66, 67. But as I said, that was not successful. Inflation came back within a year hard, and the bond market only took 6 months to get the joke. Okay? If they slash rates to that degree, the dollar is going down. We've already seen dollar yen start to adjust. This is a trade that we had from 159. Okay, we think the dollar yen's going at least to 130. And if the dollar starts to decline, remember, if you're a Japanese investor or a European investor and you're funding us, our excess spending by buying US stocks, but you have to do that with your local currency, you can't hedge it, then your returns in yen are going to start deteriorating in Europe. And the risk is that you will take the money home. And so when we look at the current setup, we look at the dynamic reflexive cycle that has been virtuous for the US for the last decade. And it looks to us that that cycle could turn from virtuous to vicious. Because if we start to enter a recession, or indeed the dollar drops, and it doesn't matter where you start on a vicious cycle, if the economy enters a recession, the current account deficit will shrink, the Fed will cut, the dollar will fall, foreign capital will leave the US by the capital account, US assets will underperform, especially equities, hyperfinancialization as CEOs cut jobs, which leads a rise in unemployment, and consumption will drop via that wealth effect as US stocks fall. This is the risk. Now,
we had a meeting in New York just last week where we went over some of the aspects of this, talking about how the Fed is really propping up the top 10% of wealth owners in the country to feed that cycle that you were talking about earlier.
Yeah. But here's the problem, Marty. There's an incredible fragility here, right? One of my clients is in the running to be Treasury Secretary, and he took a chart of a photo of this one to send to his potential boss. And his view is that this is all predicated on an equity market continuing to boom. And the minute that this thing wobbles, you will see consumption in the US, which is already stressed at the bottom end, clam up. It will just collapse because the top end will stop spending. And they are all discretionary spending. And there's a great deal of, equity trades that you can put on the back of that thing where you're basically shorting, stocks that are very sensitive to the high-end consumer and buying ones that are not. But we could talk about that offline if someone's interested. Now, here's what I would say. If we move into a weak dollar cycle, so let's say the Fed starts to slash rates aggressively because either they want to keep this game going or we go into recession and the dollar starts to decline, given that it's heavily owned by everyone with all the assets here. The last time we did anything like that was 2002 to 2008. And the sectors that did well are all the sectors that you do not own. The sector, and I'm being very generous here, right? That there was the worst performing sector was tech.
That's right. Yep.
Now, what did well in that period was the stuff that you do not own. You don't own energy, you don't own materials, you don't own mining, you don't own emerging markets, you don't own overseas, right? You have all your money in US tech stocks in the US. And if I'm right, that decade is over. And this is what I've referred to as a rotation of biblical proportions, because the last become first and the first become last. Okay? Now, the only question then is, which way does this end? Do we have to go through a nasty phase whereby we have to get a sell-off in everything before the things that you want to own in this cycle start to perform? And that's typically what happens after a bout of US exceptionism. The last one we had was into the dot-com bubble, but only lasted half as long as the current one. I want to own gold. I want to own mining. I want to own commodities. But typically, I have to go through this nasty phase where everything goes down in a recession, cause that switch. But when I look at things like this, and this is logged, so this is a perfectly valid trend line, right? When you look at gold, which is a zero yielding asset, and it is held up with the S&P since 2018. So the question is, are we starting this phase? And I think that is entirely reasonable as this virtuous cycle starts to unwind, ladies and gentlemen. And that's it.
Right. So I think that's what people don't perceive. And getting back to the reflexivity aspect, I've read a lot of Soros's books, and actually probably each one of his books has a half of it dedicated to reflexivity, is that economies are like a black box, right? And just because your currency is inflating doesn't mean that things on the inside are any better. One of our speakers last week mentioned that from a purchasing power parity point of view, China is the largest economy, the United States is second, India is third, and Russia is fourth. Whereas any people who were talking about getting into this Russia-Ukraine war were saying, well, you know, Russia is just a big gas station and the economy is smaller than New York City, but on a purchasing power parity, it's bigger than Germany, right? So, you know, I mean, how do you get people away from that, number one? And number two, you know, you had that chart of, you know, where you thought capital would float to, and maybe I don't even have an expanded version of that chart, but, you know, any ideas of publics or privates to get into would be helpful for this group.
So look, I mean, you know, I guess if you can get into privates, I mean, the big issue is going to be just the size, right, of the available things that you want to buy. So if you look at something like, you know, let's just play a game here. So if you take the tech ETF XLK, right, this has a market cap of $68 billion, right? If you take the market cap of XLM, right? So sorry, what do I want? Mining ETF, which is XME, sorry. This has a market cap of $1.5 billion. So you try and take 10% of your money out of tech and put it into minings and metals. Good luck. You better be bloody early, because you're not going to get it in without causing enormous movements. So I don't care how you own this stuff, right? I know some great funds who are effectively buying gold mines with gold in the ground at $1,800, right? They're doing a very good job. There's a couple of funds that I really do like who are buying these things, but you're not going to be able to get much money in this unless you quickly, because all the money is here. All the world's money, ladies and gentlemen, is here, and it is effectively in tech, which elements of which look from a price action. And I want to say this is about price action and ownership that look like a bubble from 2000. So I don't care how you get these things, you just need them as part of your portfolio. And you don't own them.
I completely agree with you, Julian. I think you're spot on.
That would be Tyson Halsey speaking.
Thank you, Tyson.
In fact, my presentation in about 20 minutes will echo many of these same themes, but yours is underpinned via currencies and really but comes to the same conclusions. But I share exactly your viewpoint.
Yeah, I just think, look, you've got to think of it. If you've been a European investor, since 2014, you've had a massive two-phase trade. The euro has fallen from, you know, or since 2011 from 160 to 1 at one point, right? And if you put it into either US corporate debt, which was higher yielding back then, or you put it into US equities, you made out like a bandit, right? But
any thoughts on the Japan carry trade, Julian?
Yeah, I mean, look, the Japan carry trade was kind of like the last gasp. If you want, if I look at this, one of the reasons that we put on the trade that when we went short dollar yen back up at these levels was that we've seen this massive divergence between the interest rate differential, which typically drives dollar yen, and dollar yen, right? It was huge. And what had caused that to a large extent, Marty, was this inflow into Japan launched these new NISA accounts, so these sort of private savings account basically for individuals. And they were hoping to direct money into the Japanese equity market. But of course, you know, the bank said, well, why don't we come up with tech US tech focused funds, and that's what they did. And so Japanese retail piled into US tech completely at the wrong time, right? Completely at the wrong time. And ask yourself, if you're in NVIDIA, you're a Japanese investor in NVIDIA, the chart in NVIDIA in yen terms looks very, very different from what it looks in dollar terms. It looks bad enough in dollar terms, but you put it into yen terms, this thing looks horrible. Right? And bear in mind, the whole of the world owns these assets in their own currency. Otherwise, they can't fund the current account deficit.
And any other thoughts on this China, real estate crisis or real asset crisis? I mean, I think that what I've been told is that the Chinese tend to avoid, the public markets, and they have invested a large chunk of their GDP into real estate and other real assets. And it seems like the market might be taking a turn.
There's a couple of things that I would say. Firstly, just some observation on China. Look, it's very weak, we know. You're not going to get a stimulus till after the US election. They're holding their fire on that one till after the election to see whether Trump is elected and we get tariffs. Secondly, anecdote that I heard was that the first time in years, China has started to import physical bars of silver. Now, they're quite a big consumer of silver because of solar panels. But if we are starting to see this desire for precious metals starting to run down to retail levels, and they're going to buy silver, which after all, come the apocalypse, it's an awful lot cheaper to buy a loaf of bread with a bar of silver as opposed to a bar of gold, right? It'd be a very expensive loaf of bread if you have to buy it with a bar of gold. If they are starting to get into physical silver, then this baby is about to pop. And it's one of my personal favorite trades if we see the dollar start to weaken. Now, just on a very short-term basis, I will say, I think the Fed was preparing to go 25. That's what I was told by my policy contacts. I think it's probable that they'll be bounced into 50. I do not believe that they will lower the dots anywhere close to what the market is doing. So I think there is a risk of disappointment. I think there's a feeding frenzy going on in asset prices at the moment. This assumption that the Fed is going to slash, it is going to save you, it is going to do everything. Historically, at this point, they are already too late. The recession is upon us. And if they do slash and they try and save us, then I think the bubble in US asset prices unwinds courtesy of a weakening US dollar. And you're meant to own things overseas in an environment that the dollar starts to weaken.
Julian, any thoughts on retail versus institutional investing on all this? I mean, obviously, all retail investment media is always buy, right?
But I think, when you look at institutional has done extremely well by being invested in the US. I think you have to forget, Marty, there was an interesting anecdote. So in 2014, as policy started to diverge, I have a friend of mine who is chief strategist at one of the private Swedish banks, and he took the 6 most senior guys from the real money accounts in Sweden in to see the Riksbank. And the Riksbank told them to their faces that they were going to start QE. And they were going to push rates down to 0 and into negative territory. And these very senior guys, who between them run the 6 largest real money accounts in Sweden, all came out, went straight down the pub and got drunk because they could not figure out how they were going to make returns for their clients. And what they came up with was what they were going to do was buy US assets because it was going to be the only place that they could get positive returns. Well, they've done, and we all own them. And if you're sitting here happy the fact that you've done extraordinarily well on your US tech stocks for many, many years, but you don't want to contemplate diverging from there, I am telling you now, do not wait. Because if that XLK versus that XME is any indication, then you're trying to take 10% of that 65 billion that's in the XLK and put it into the XME where the market cap is 1.5. Good luck.
So let me take a devil's advocate point of view. I mean, so you're talking about this, one of the things that we've talked about a lot is bifurcation of the economy because of these 6 or 7 companies that have $100 billion each of cash, right? And they're not really touched so much by this, right? I mean, so you've got the momentum chasers, which you're calling the people from Sweden, and then you've got the people say, well, you know, Google's got $100 billion of cash, Apple has $100 billion. You know, they all term as cash reserves to weather the worst downturns, right?
Sure. Sure. So maybe they weather it. But the question is if we go into a recession, what do people own, right? If we go into a recession in the United States, which given the employment setup is the base case, ladies and gents, right? Now, we haven't got the layoffs, but we are one step away from those layoffs, right? Now, if those layoffs come, we're going into recession, okay? And we are going to drop 30% on average, okay? And you're going to sell what you own. So maybe if you want to get cute, okay, and you want to pick your sectors, fine. But they're all on average going down 30%, and they're not going to do what they did in 2020 because they're not going to have the benefit of a $6 trillion bailout balance sheet moved by the Fed. It's the only reasons why the stocks rallied in 2020 was because the Fed printed so much money, and they did it after they dropped 30%. Okay?
So my other question, sorry, I'm asking too many follow-on questions, but you know, I see AI as being a hastener of letting people go rather than creating new jobs.
That's a completely different conversation, Marty, right?
I'm just saying that rather than being a catalyst for growth, I think at first it'll be a catalyst.
I think it's entirely possible, mate. And look, you know, maybe AI is going to do what AI does. Make sure you live somewhere safe. And just be prepared for 99.9% tax rates on anything that generates profits, because you're going to have to pay it out to the whole population in a universal basic income, unless you want to live on the island surrounded by a private security firm and you're shooting people as they come up to your nice house, because that's what it's going to end up with, right? If that's that world we're heading to, Marty. I hope we're not. I think we would all agree that we would rather pay the 99% tax rate if you're Google, but that's what it's going to occur if that's where it's going. I think it's just going to take longer than we think. Okay. And that's what happened in the dot-com bubble. It wasn't, forget, I'm not talking about pets.com. I'm not talking about Cisco, but Microsoft's PE was almost identical to where it recently hit. It was growing into its PE. The stock just underperformed for a decade and still expanded, right? We still kept using Windows. We still kept building out the internet. It was just that the stock was over-owned.
Fantastic. This is excellent. And I want to make sure that we get Axel Merck on, who's
He's
probably
on. He's on.
one of the largest you know, gold managers in the country. So Julian, thank you so much.
Pleasure. If anyone needs to get hold of me, Julian at mi2partnerswith.com, and it's Julian with an A, not an E. I'm English, not French.
And if you could do us a favor and post that.
Yeah, can you send me the latest deck so that way we can post it?
Yeah, absolutely, sir. Yeah, I'll send it right out to you now.
I'll distribute it on a follow-on email as well, so that way people can you know, review it and contact you. So
Perfect.
fantastic.
After that,
Thanks
after
very
that
much,
speech,
guys.
I think gun sales went up.
Look, you know, I've always said I hope that that's not the case, right? I mean, if you know, I always struggle with people who go and buy gold, you know, in for the end of the world trade. As I said, it's a very expensive way to buy a loaf of bread. And ultimately, you know, in the end of the world trade, there's only two metals that you need, lead and brass. Because I can pretty much get all your gold and your bread with lead and brass. But anyway, have a good one.
It's hard to get to Switzerland when everything crashes, right?
Yes, absolutely.
I love the sense of humor. Great job.
Thanks so much.